Hello, I'd like to welcome shareholders to this presentation. It's been time to accompany the AGM results. My name is Sandy Nair, and some of you as shareholders will know me and will have spoken in the past. Others may be the first time we've had a chance to talk. I've been involved with the Trust since its inception in 2003. Initially as the investment manager and CEO of Edinburgh Partners, and now that the company has become self-managed as the investment director on the company. I've really got three objectives today. I'd like to firstly talk to you about how your company is being managed and to introduce you to the team that's involved with the management of your assets. I'd like to spend a little bit of time talking through the investment objectives to give a better flavour of the risk-reward profile and the tolerances associated with that. And then we'd like to discuss portfolio returns since the change in policy. But first, what I'd like to do is just talk you through the history of the company since its inception, why the changes that took place in 2021 were felt to be the best way forward for the company. And that will then bring us into the discussion of how the company is managed, how the assets are managed, the new relationships that have been built up to enhance the returns in the future. So let me now turn to the history of the company. The company was launched as Edinburgh Partners Global Opportunities in 2003. And one of the things we felt important at the time was to have an investment policy and objectives that gave us significant degrees of flexibility in managing assets. Since one of the issues you face is if you have constraints that are inappropriate or turn out to be inappropriate, then you're forced into making investment decisions that may not be in the best interests of shareholders. So for that reason, we had a degree of flexibility in the amount of cash we could raise. For times when we felt assets were too expensive. We also had the opportunity to invest in private equity if we felt that was appropriate, although given the conditions of the time, we never actually utilised those permissions. And then we had the freedom to invest in other assets. But we knew at the time that we launched that equity markets were not particularly expensive. There were opportunities there. So for the first period up until the global financial crisis, the trust was really managed as a global equity portfolio, although cash began to build in 2007 as valuations became more and more expensive, and I think it peaked somewhere in the 20% sort of range. Why is that history important? It's important because the reaction that we all know about now that came from governments worldwide was the suppression of interest rates. And what the suppression of interest rates did was it inflated pretty much all assets in the world. So as time moved on, it became more and more difficult to run the trust in the way, to run your company in the way we felt was appropriate, because the constraints that we had thought would not be binding when we set it up began to become binding. So for that reason, we came to shareholders and asked for permission for greater flexibility and greater freedom so that we could navigate the markets and the conditions in markets that had dramatically evolved since 2007. And, the background to this is, in terms of research I was doing, I penned some thoughts in a book called The End of the Everything Bubble. This is not a suggestion that we're negative in assets at all times, just an indication of where we think we are and why we needed those, the degrees of extra flexibility. We were fortunate that shareholders overwhelmingly voted in favour of the change in investment policy, and that was then instituted. And as we go through the presentation, we can talk a little bit about what that does for risk and reward and returns. So that history is important, but really two other things I think to mention in the context of the changes. As part of the changes, the trust became self-managed. And then secondly, because we had removed a number of those constraints, and because, particularly in the past 12 to 18 months, we've seen, if not the end, certainly a relaxation in the interest rate suppression, that has changed some of our views, particularly relating to the dividend. And so we consulted with shareholders. We now have built up reserves that can be distributed. And as a consequence, from the feedback from shareholders, from the increase in reserves, and because of the greater flexibility, we doubled the dividend in the last year. So just to explain, prior to that period, having a prescribed dividend could have forced you into companies paying dividends that you didn't really think were the right risk reward profile. That's not the case at the moment, and for that reason, as I say, the dividend was doubled. You're going to get quite a lot of information and description of how the portfolio is managed by my colleagues that are going to follow. But let me just introduce the relationship that was brought to the company after it becoming self-managed. One of the things that was clear going through the interest rate suppression period and the inflation of assets was that in order to navigate the environment we now face, you need access to specialist skills. One of the mistakes portfolio managers like myself often make is they come to a belief that they can do everything rather than recognizing where their core skills are and bringing in skills from people who can augment what they do to try and create a better overall solution. And that, in a nutshell, is the explanation of the relationship with Goodhart. And the gentleman you will meet later on in this presentation, I hope you'll be able to understand after the dialogue what they bring to the management of your assets. But let me start with Alan Bartlett. Alan is the CEO of Goodhart Partners, somebody I've worked with for a long time. He brings many skills, but one that stands out is the management of risk and reward within a portfolio. It's all very well running a portfolio and having an understanding of where you think value is in the market, but unless you structure the portfolio correctly, you're not going to maximize the returns. And one of the things that I've always felt Alan, a set of skills that he carried that are not prevalent in the marketplace, was the ability to structure portfolios to try and both maximize returns and minimize risk depending on where we are in the particular cycle. As you know from history, my background is in value investing, although one needs to be very cautious about the definition of value. I take a fairly eclectic definition, not the kind of very narrow, deep cyclical type of view. Why do I mention this again? I mention it because analysts tend to have skills in particular areas, and the skills that we brought in, we believe, are complementary. So, Russ in terms of seeking out growth stocks, James in terms of mid-cap, well, Russ in terms of mid-cap as well. The reason, again, just to re-emphasize for the relationship with Goodhart, is to bring in access to skills where we believe we're going to find value for the company and for you as shareholders. So if you look at, turning back now to the risk reward in the portfolio, as I mentioned earlier, for some time we've had concerns about valuations. The market has, I think one of the reasons it's been rotating so violently is there are kind of two camps. There's a camp that also has those concerns, and there's a camp that doesn't and believes that the type of interest rate suppression period can go on indefinitely. The portfolio is currently positioned. Defensive is probably an overly broad description, but it works for the purposes of this presentation. What we are trying to do is protect your capital so that it's available when the opportunities present themselves, whilst at the same time still being able to generate positive returns in an up period. So our expectation at the moment is that if markets rise sharply, we will lag them. Then if they fall, we should try and protect a large proportion of your capital to keep our powder dry to take advantage of the opportunities that are then created. But rather than me speak too much longer, I think the best thing to do is to pass you over to my colleagues who can talk you through both the specific returns in the last period but as importantly, the context since the change in policy, and let you hear from the people who will also be directly involved in managing your assets. So I'd like now just to pass you over to Alan Bartlett to pick up the baton and talk you through more about what we're doing with your company.
Hi, I'm Alan Bartlett. I thought maybe we should start by talking about what the investment strategy, the objectives are for the Global Opportunities Trust. We're trying to compound real returns over the long term with an approach that we call agile investing. The strategy itself is relatively simple conceptually. It's a global equity strategy that has a very flexible approach to what the market exposure is. And in simple terms, we're trying to take responsibility for both the risk and the return generated by the strategy. I think conventional global equity strategies tend to be fully invested, and you're forced to be taking risk on markets all the time. Our view is that there are times to take risk and to be exposed to markets, and there are times to try and protect downside. And so in simple terms, when we have lots of investment ideas that we have high conviction in, we're more tolerant of risk and will allow the market exposure of the strategy to go up. And when we can't find as many convincing investment opportunities, we'll focus more on downside risk and preservation of capital so that the net market exposure of the strategy will flex over time. We think that's very important on an ongoing basis because in simple terms, we think that much is changing in the world and that it's going to be increasingly important to be flexible, to be able to adapt to different market environments as they evolve. And so agile investing to us is the sort of confluence of that flexibility with the willingness and the ability to focus on specific investment opportunities that we think can generate high returns over the long term. So I think it's pretty legitimate to ask, why would you try to run money in that kind of way? And if you think about returns over the last 30 years, certainly the 30 years to COVID, it's an incredibly benign environment to invest in. The period started, I guess, with the resolution of issues in the banking sector, savings and loan in the US, and ended with COVID. Through the mid-1990s, we had the Asian financial crisis into the TMT bubble and burst. From there, through the commodity super cycle to the global financial crisis, and then that wonderful run from 2009 all the way through to COVID with just a mere hiccup in 2013 with the taper tantrum, an amazingly benign period for equity markets that generated over 8% per annum nominal and well over 5% per annum in real terms. And I think during that period, it became very logical for people to adapt to the idea that equity markets were benign and that returns were very attractive, and they were. Down swings in markets were pretty short-lived, and as long as you invested broadly in markets and held on, frankly, you had a nice long-term return on investments that more than met most people's requirements. So why would you now want to be more flexible when you've kind of proven over multiple decades that actually just being passive, for example, is a really attractive investment strategy? And I think the way to think about that is to try and unpick what drove equity market returns over that long-term period. And we sort of think about it in terms of four forces that drive the world. And in simple terms, these four forces conspired over that 30-year time period that ended with COVID. They conspired to support globalization and to support this sort of very benign environment for equity investing. The four forces being demographics, security, the environment and technology. And so during this period, we had a significant increase in the global workforce because the industrialization of emerging markets, which was clearly very positive for economic growth. Post the fall of the Berlin Wall, it wasn't as necessary to spend as much on defense, and perhaps more importantly, it became safer, if you like, to extend supply chains for industries, which made it easier to produce things cheaply, particularly with this large increase in the workforce in emerging markets. The third force, environment, was important simply because it didn't really matter. For most of that time period, we were able to essentially treat natural resources as unlimited and didn't price externalities to their full extent, if you like. We've always had environmental issues, but they were more local than global over that time period. And on the technology side, clearly it was the age of the internet, the business models that supported Microsoft and Apple and Google, etc. And all four of those things combined logically led to a very strong environment for equity investing that you see in the numbers. And also, I think, explain why we have had such a significant rise in passive investing, ETF, even the rise in the allocation that pension funds, endowments, foundations, etc. had towards private capital investments, so private equity, private debt markets, because in simple terms, all you had to do is invest in markets and hang on for the long-term return. Problem that we think you have now is that three of those four forces are no longer a benign impact on economic growth. The one that stands out that still clearly is technology. The way we think about it, technology is moving from the digitization phase to the assimilation. So digitization being, the move to the internet and digital business models, but we weren't actually able to read the internet. And now with large language models, we can. So the adoption of AI, artificial intelligence, the business plans that are going to come from that are going to be transformational for productivity and are going to be fantastically interesting long term. However, we've passed a tipping point on demographics. The global population is aging. Outside of Africa, there really isn't anywhere where the working age population is growing on a forward-looking basis, and that's going to cause issues. On the simple level, less people to do things, and that is really important. If you look over the very long term, you think about 40% of economic growth comes simply from more people. So that going into reverse is a bad thing. But actually, dig within that, there are other more significant, even more significant issues potentially in terms of the inequalities created from the last 30 years. In simple terms, all the assets are owned by old people that have benefited from low interest rates and inflated asset prices. We've got less young people that are going to be working who have to go buy houses that are now really expensive. And how some of these things play out over the next decades is going to be very interesting and complex. But demographics is not a positive for economic growth anymore. Clearly, Russia invading Ukraine has focused everyone's attention on defense expenditure, but it also, COVID showed the limitations and the risks of having extended supply chains for businesses. So we are undoubtedly in a period in which security on every metric, whether it be cybersecurity, guns and ammo, or supply chains for industry, is high on people's agendas, and people are going to have to spend more money on increasing security, largely at the expense of economic productivity. And unfortunately, from an environmental perspective, we have really got no choice but to start trying to price externalities because the issues are undoubtedly global, not local. And as a father, I'm extremely supportive of the desire and the need to move to a more sustainable future for our children and our children's children. But from a conventional economic growth perspective, spending money on environmental technologies isn't good for short-term economic growth. You only have to look, for example, at the increasing cost of UK electricity, which is largely driven by the move to more green electricity and the impact that that has on the input costs for industry in the UK and productivity, to see that in the narrow short-term sense, economic productivity is negatively affected by environmental sustainability, notwithstanding the fact that it is incredibly important and we should all be supportive of it. So three of the four forces to us are negative for economic growth on a forward-looking basis, with technology being the great hope, if you like, for the future. But it's far from clear that the aggregate of all those things is positive. And if you think about that wonderful 30-year time period that ended in 2020, in which we were able to generate 5.5% or so real returns on equity markets, economic growth was pretty anemic, actually. I mean, across the world, maybe 2.5% per annum. That's in an amazingly positive environment. And so from our perspective, on a forward-looking basis, asset prices aren't going to be supported by particularly strong economic growth at all. Even if we just continued the 2.5% that we had in a very benign period, that wouldn't be exciting enough for asset prices, really. But we think it's going to be likely worse than that, despite the positives from technology. A major problem alongside that is just asset prices. If you look at the US, for example, cyclically adjusted price earnings ratios are close to all-time highs, more expensive than they were before the depression in the 1930s, for example. House prices in the US are as expensive as they've ever been. Equity in housing in the US is at an all-time high. What that does is it creates significant wealth effects. So if markets fell, the impact on individuals' wealth is significant, and that would cause quick and significant sort of retrenchment of spending. I mean, the US is a consumption-led economy, not a savings-led economy. Savings rates are low, but in adverse times, savings rates increase dramatically. If you look at what happened after the financial crisis, it was very quick. If that were to happen again, there's no question that a relatively shallow potential recession would become a very significant recession. So we've got some big long-term factors that are adversely affecting long-term economic growth, combined with very expensive asset prices in the short term. From a simple perspective, we think it makes perfect sense, given those things, to prize flexibility and prize the ability to be able to focus on specific investment opportunities that are attractive, rather than implicitly bet on everything being okay and owning a little bit of everything, being passive, for example, being the way forward. Returns in 2024 are a little disappointing. We're pleased to have generated an absolute return, but would have been happier with a little bit more performance. Coming into 2024, the environment was very challenging to us because for the last 3-4 years or so, the Global Opportunities Trust has been positioned in a pretty defensive manner. But coming into 2024, you could see an environment in which sentiment could support stronger returns on the equity market. Base effects meant that inflation was going to be falling, and so the narrative would build for central banks to be able to reduce interest rates, and that would support asset prices, etc. And in the run-up to the US presidential election, there were a lot of things combining to make it look like asset prices could go up, but against the backdrop of significant macro issues and concerns that we had, I mean, specifically in the US around the size of the national debt and the cost of financing it. Because much in the same way as if you buy a house, the cost of the house isn't necessarily the thing that's critical, as long as the bank's willing to lend you lots of money for a mortgage. The thing that really matters is how much your mortgage costs. It's the same for governments, really. So US national debt has been rising for the last few years and is significant, but the problem that has really been rising is the cost of servicing the national debt, and we could see that coming in the back end of 24 and into 25 and becoming a really significant issue, so a negative. But the positive being falling interest rates and the obvious human desire for the world to be okay and everyone to be positive and equity markets to go up. So we added some more cyclical risk to the Global Opportunities Trust at the beginning of 2024. we wanted to add more, to be honest, but we were struggling to find things that were cheap enough. We found a little pocket of things that we thought were attractively priced on a longer term basis and that we could stomach, if you like, on a macro perspective in the shorter term, particularly in the UK. So UK mid cap value stocks. We also bought Alibaba in China because I mean, it had just gone down an awful lot, and we thought it had a lot of option value. And from a portfolio perspective, it's very valuable to have something in a portfolio that can go up a lot when other things are struggling. And we saw some potential for that with China having just a different economic and market cycle to other markets. And, by luck or judgment, that worked really well over the last year or so. We exited the larger cap Japanese equity stocks that we held directly in the portfolio in around April 2024. They'd performed very well. Japan was a sort of flavor of the day at the time. Weak yen meant that it flattered the earnings of exporters in Japan. And as Japan started to outperform America, flows started to be significant into Japan. Large caps outperformed a lot, and our problem was we just got to valuations that were just too expensive. So we rotated out of larger caps into a smaller cap, more domestically focused exposure with a company called Asset Value Investors that we invested in a fund that they have that is a Japanese small cap fund. Good Heart Partners actually is an affiliate of Asset Value Investors. We own a stake in that business, and I'm on the board of that business. So it's not really third party to the extent that we have very unusually detailed understanding of the investment process and the way they manage money. That switch from large cap exporters towards domestic small caps was, it worked very well over the last year. Asset Value Investors' performance has been fantastic. They're more of an actively engaged investor, and it's more of a play on corporate governance reform in Japan, which is a theme that we're very positive on structurally for the long term. We roll through to the summer, in advance of the US election. We found a few more stocks that we frankly could stomach buying. Breeden, the UK aggregates business, being one example. So we added a little bit more market risk, a little bit more discounted UK equity risk to the portfolio, but not enough, frankly, given how strong broader equity market returns were. The challenge is that we're only going to buy things if we find investment opportunities that we really believe in. We don't think that forcing yourself to take market risk just because you think markets might go up is a terribly good idea. It's not fundamental and robust enough from our perspective. And so despite sort of grubbing around the market trying to find things that we liked, we just couldn't find enough of them. So the net of all that was a positive but modest return over the year. Towards the back end of the year, we rotated out of our short exposure in the portfolio that had been a bit of a hedge on markets, and right before the year end, we added to European mid-cap value stocks. That was another seam, if you like, of attractive investment opportunities that we found. The trick, the challenge there was that whilst we see significant long-term upside to those stocks, they are quite cyclical in the shorter term. So from a portfolio perspective, we didn't want to add too much to that because it does bring downside risk to the portfolio. But we thought some exposure was justified by the upside potential. And then frankly, if Sandy and I are wrong on some of the bigger picture things, would provide more underlying market exposure and beta, more potential absolute return for the strategy in environments where the macro ended up being more benign than we thought. I think that the market performance in 2025 so far somewhat vindicates the positioning that we had in 2024. Performance, certainly relative to equity markets this year, has been good. We've managed to keep the low volatility and generate an absolute return against a backdrop in which the US equity market has been very volatile and fallen significantly at times. Clearly, the the euphoria markets around Trump petered out pretty quickly, and as the narrative turned to tariffs, etc. And I think that sort of highlights the problem in some ways of trying to be opportunistic in markets. Agile doesn't mean high turnover and being, trying to outperform in every single market environment, if you like. It just means being able to adapt significantly over time. And, I think the reality is that if we'd pushed up market exposure in 2024, we would have done a lot worse in 2025 so far. So hopefully the positioning that we've got that didn't help performance, particularly in 2024, is going to really help on a forward-looking basis. So we added to European mid caps. Outside of that, we've trimmed a few exposures. If you think about the portfolio themes, defense has worked very well. It's an exposure that we've had in the Global Opportunities Trust for a long time, for many years, but it really became fashionable this year for obviously awful reasons. And performance has been very strong. What's been really useful about the defense exposure over the last few years is the asymmetry of return. I think when you identify an opportunity where change is really driving the investment idea, that's how you create asymmetry in a portfolio. And so in simple terms, when markets were selling off over the last few years, defense stocks haven't really sold off that much. They've been relatively defensive, but in rising markets, they've caught quite a lot of the upside. So a wonderful sort of asymmetric return profile to achieve in a portfolio. I think now that the theme around defense is sort of well understood and focused on by other people, that asymmetry goes away somewhat. And so the challenge is that we think that the stocks are still very attractive on a longer term basis, but that sort of diversification within the portfolio is less attractive than it was. So that's how we calibrate that in the portfolio on an ongoing basis is one challenge that we're wrestling with at the moment. The other, frankly, is that the exposure that we call resilient has just done really well. The resilient stocks in the portfolio, the idea there really is that, frankly, they're just boring, or rather we hope they're boring. These are stocks that are 2 to 3% dividend yields with 3 to 5% earnings growth. Hopefully we catch some idiosyncratic return from picking the right cycles in these businesses, but the idea really is that they can compound at 5, 6, 7% per annum over the long term, pretty much regardless of what happens in the broader market. But we had about 4 years worth of that in 3 months this year, because the market started to worry about things around Trump, etc. And many of those frankly boring stocks were up significant double-digit amounts. We sold Tesco because it had performed very well, and was no longer cheap enough for us, with uncharacteristically good timing, courtesy of Sandy, given that it had an earnings miss shortly thereafter and the share price went down significantly. We also sold Imperial Brands, despite the fact it was still cheap actually, but it's not something that really deserves a sort of premium multiple, because ultimately it's not going to grow over time, and so we moved on. So the challenge now for the portfolio is that we're not finding attractively priced, resilient, boring stocks. And so we've recycled some of the capital into the more cyclically exposed, but very attractively priced on a long-term basis stocks in Europe. But we're trying to be very careful about the overall weighting, because we remain pretty bearish in their longer term perspective around the macro environment and broader valuations. And that's the trade-off, if you like, that we're trying to manage in the portfolio. In simple terms, I think there are 3 elements to the challenge today. The first is obvious relative value. If you look at things like large caps versus small caps, developed markets against emerging markets, US equity versus non-US US equity, on a historic basis, there are very significant relative value opportunities there. But the Global Opportunities Trust strategy is absolute return oriented. So the relative return has to be put in context with what the absolute opportunity is. The second component is the absolute return opportunity. And over the last 6 months or so, we've significantly enhanced the investment resources that we have at Goodhart. We have more firepower on stock picking, and we are finding more stocks today that have significant long-term upside to them, which is exciting. I think Sandy wrote his book, The End of the Everything Bubble, published in 2021, and the good news is we don't think that we're in the everything bubble anymore. Broad markets are still very expensive, but not all markets. Fixed income markets have corrected significantly, and we are finding more individual securities around the world that make a lot of sense from a longer term valuation perspective. But most of those need a relatively benign macro environment for the value to really come through. And so, that macro component has to be weighed against the longer term upside that we see in individual stocks. In simple terms, that's the challenge today. How do we balance attractive relative value, very attractive absolute upside over the long term, but with shorter term macro headwinds that can significantly impact returns over the shorter term? The portfolio at the moment is about 64% invested, so roughly 2/3 invested, 1/3 in cash and money market funds. So there's plenty of dry powder to take advantage of weakness in markets. But we've also got significant exposure to stocks that we think can go up a lot over the long term. The correlation of the strategy to equity markets over the period since the investment policy was changed towards the back end of 2021 has been very low. Actually, we've had negative correlation with the broad equity market over that time period. I think it's important to note that that isn't going to be the objective forever. We've been managing the strategy to have low absolute risk deliberately for the last few years. So the fact that we've had very low correlation to equity markets is a natural byproduct of doing that successfully, if you like. But in simple terms, we prefer to be correlated with markets when they go up and not correlated with them when they go down. Clearly, that's not an easy trick to pull off, and certainly not with any great precision. But I think it's important to note that the low volatility and the low correlation of the strategy with equity markets, won't be a permanent feature of the strategy. We will flex the exposure, and actually today, the market exposure of the Global Opportunities Trust strategy is a bit more than it has been over the last few years. That's simply a function of the fact that we're getting more individual stock ideas that make a lot of sense from a longer term return perspective, but the overall positioning of the strategy remains very defensive. We would think the downside beta of the portfolio is in the kind of 0.2 to 0.5 range. So if market fell 20% and we were down 5, that would be a good result for the way that the strategy's positioned at the moment. I mean, we are greedy, so we'd like to do better than that. But intellectually, that would be a decent result for how the portfolio is positioned at the moment. And that's worse, if you like, than we did in 2022, where we had a significant absolute return in a falling market. But the quid pro quo, if you like, for that is that we think the strategy is better positioned in other environments where markets are more positive, and longer term, we're very confident in the underlying stocks that are in the portfolio. I think a really interesting development in the team that supports the Global Opportunities Trust actually is that Goodhart has been able to bring in some fantastic investors that complement Sandy and myself. So now we have a 9-person global equity team that has been structured very much with the idea of agile investing at the forefront of our minds. So we have an unusual investment capability because we have a team of people that have very different approaches to investing. And often boutiques tend to have one way of investing, value investing, growth investing, quality investing. And the essence of agility, if you like, is to have the flexibility to adapt to different market environments and different types of investment opportunity. Sandy and I have our own biases. We have the things that we're comfortable with and things that we struggle a bit more with. So it's wonderful to be able to attract some people that have skill sets that are very complementary and expertise in areas where we just don't have the same capabilities, and to find some people who believe in the vision, if you like, for running money in a more agile, more flexible, longer term way. So we've brought in Russell Champion, for example, and Andrew Heap, who are both growth specialists. You know, Russell has a particularly strong understanding of technology, artificial intelligence, and a very clear view of the sort of business models that are going to work for the next 10 years in that space. It's an area that Sandy and I have been enormously interested in, puzzling over, speaking to lots of people, trying to understand the business models. Sandy being Sandy is actually trying to understand the code. But the truth is that having an investor in the team that really understands that investment universe and the opportunities is fantastic. And being able to trade off those sorts of investment opportunities against the other things that we've got in the portfolio improves risk-adjusted performance potentially, but it creates a very rich debate within the team. Another person that we've brought into the team, James Sim, I think is going to have a particular focus on supporting the Global Opportunities Trust alongside myself. He joined us from River Global. He's a European mid-cap, contrarian-y value business cycle type investor. Speaks the same language and Sandy and I, has more of a focus on meat and company management. He really likes to, look at company management in the whites of the eyes and try and get into the detail. Sandy and I are a bit less about meat and company management, a little bit more about thinking around the context within which companies operate. James is right in there, beating up on management, trying to understand what's changing, trying to get a detailed angle on businesses. And that creates a very rich debate within our team on individual stocks and overall portfolio positioning. And we have a number of other people that have joined the team as we try and build out the capability to support Global Opportunities Trust and Goodhart's wider business. And what I really want to do is to introduce a couple of them and try and show you how those kind of ideas get generated and how we talk about them together. Hey James, good to see you. Long time.
Long time.
So you joined us back in January and had a pretty immediate impact on the Global Opportunities Trust portfolio, including pushing out a couple of my stocks. I seem to remember Whitbread being one of them because your ideas were better than mine.
We'll find out.
Yeah. Given that, maybe you could just pick a couple of the stocks that are in the Global Opportunities portfolio today that are your ideas and talk them through briefly and kind of bring out where the focus has been.
Yeah. So what obviously we're trying to do, Alan, is look kind of under the rocks to find those hidden gems in Europe. So one of those that I'd highlight that we've put in the fund, haven't we, is Danieli. Mm-hmm. This is an Italian family-run business. It's good Italy. It's from Trieste, so near the Swiss border. It's been stewarded by the Danieli family for 50, 60 years. And what they do, they make the kit that steel companies use to make steel. And it's a business that struggled to grow really in the last cycle for obvious reasons. Most steel companies were going bust or under pressure. There was no need or impulse to spend capex, so it didn't grow. So it's a good business. It's a 3-player market, quite high returns, reasonably profitable. Now, looking forward, there is a big investment wave starting to come through in the steel sector, and it's partly a function of having not invested in the previous cycle, so a lot of the kit being obsolete, but also because of the need to produce steel in a much less carbon intensive way. And that's an environmental imperative, isn't it? But it's also a cost imperative, actually, particularly in Europe, where you have to pay per ton of CO2 that you produce. Yeah. So all those blast furnaces that we sort of see around the world, which is still the majority of steel production, are effectively becoming obsolete. And when they're replaced by an electric arc furnace, so people might remember the steel plant in Scunthorpe that was bailed out by the government recently. And one of the problems that had was it wasn't cost competitive because it was producing a blast furnace. And the number quoted in the press was 3 billion. to replace that with electric arc furnace. So whenever you sort of see that kind of headline of a steel company making an investment or decarbonizing their production process, you think Danieli will have their fair share. And that the order book for that company, which is starting to come through in profits, but gives us a good runway for profit growth for many, many years. The order book has gone from 2 billion to 6.5, and on our numbers, we think it's going to 9 billion by the end of the year. So a long runway of profitable growth. And the great thing about being an undiscovered European gem family Italian business is it's very highly net cash. The net cash is almost the market cap, actually. So
Yeah, that was the thing that did it for me.
yeah, well, that with the Japanese sort of thesis on the Japanese reform, it's got similar characteristics, doesn't it?
Yeah.
So from a valuation point of view, it's incredibly cheap for the quality of the business, and I guess that's what we're trying to find.
So does Danieli have an angle on Ukraine, the reconstruction, if the war ever ends?
Well, I think it's got an angle on Ukraine reconstruction, but it's also got an angle on militarization of Europe. So defense spend. I mean, a tank is 95% steel and weighs about 70 tons.
I remember the other day, actually, you were doing that calculation.
Yeah, we were working out how many cars one tank is equivalent of. If car production drops in Europe, how many tanks? And it's not many, right, because of the steel content. So militarization is a big theme. So increased defense spend in Europe. And also, if there was a peace in Ukraine, which I don't think precludes generally increasing defense spend, but if there was a resolution in Ukraine, then that's a very big country. It's a huge reconstruction project, and that plant that is now under sort of Russian control, the Astava plant where they all were hiding in 2022, that's 4% of European steel production. So I think that's partly what's driven steel price up in Europe sustainably, and will, it's a long wave investment reason for steel companies to invest.
Great. Second stock?
So Devestalo is another company we've put in the portfolio.
Yep.
More resilient business, more defensive characteristics. So it provides healthcare in Finland. Now, Finland has a very aged population in terms of dependency ratio. So it should have a expensive healthcare system with difficult outcomes. But actually, the value that the Finns get from their health spend as a percentage of GDP is very good. They have very high quality outcomes in healthcare. So you have something called a Kela card. You can spend that in the public sector. You can spend it in the private sector, and the government will pay part of your operation. You can top it up. So the ecosystem is a very sort of market-friendly ecosystem. And Tevestalo's been at the heart of that. They've historically gone for some forays into other countries which haven't got the same characteristics, Sweden notably. So they're retrenching from that and just executing very strongly. They've got lots of margin upside. It's a bit of a recovery stock actually from COVID, which obviously caused a bit of a downturn for a lot of healthcare companies, lots of disruption to the system. So it's recovering from that. And I think, going forward, it should be growing mid to high single digits. It's got a 4-5% dividend yield. It's becoming a sort of dividend aristocrat, if you like, and we're paying sort of low double-digit multiple, so it should compound over time very, very nicely.
And healthcare is a really interesting place to get exposure to, and then the Global Opportunities Trust actually did very well out of healthcare stocks in 2022, but Sandy and I sold them as we came into 23 because the US sort of situation around healthcare, potential taxes, etc. So nice to get a play on an interesting long-term theme at a cheaper price, right? And in a sort of specific market where the opportunity is easier to see where the risks are, if you like.
Yeah, and obviously demographics is one of the sort of four forces, isn't it, that we think is going to dominate equity returns through the cycle, and clearly aging population is a big part of that demographic shift. So the need for Tevestalo within the Finnish healthcare system and the ability for them to generate market cap ultimately from profit from taking share within that it leads to this sort of nice long runway of dividend growth over many, many years, I think.
Yeah. I mean, one sort of clear characteristic of the way that you invest is the desire to look management in the eye and So you travel quite a lot, you meet a lot of companies. Maybe sort of talk about what value that brings to your process.
Yeah, I mean, obviously technology has changed, hasn't it, a huge amount in the investing world in the last, 10 to 15 years. 10, 15 years ago, you could get an edge by putting some numbers in a spreadsheet and building a forecast, right?
Yeah.
Now we can do that in, 2 minutes using some artificial intelligence tools that we've got. So, reading company statements, by 8 o'clock, we can read every company statement that's been put out and, using various tools. So I think what I would call small data of meeting management and really understanding like what is changing within the company that perhaps you can't glean from the internet or public statements that they've made, or that you can't find in a model, probably becomes more important actually than it ever was. And Europe's just not an efficient market in the sense that perhaps the US and to a degree the UK are. There's lots of companies that are very stakeholder orientated. They haven't necessarily focused on shareholders and communicating with shareholders. So getting on a plane, going to Zurich or Frankfurt or Milan or Madrid or a center of European finance, meeting 5 or 6 companies in a day, and having obviously thought about which companies you want to meet the potentially attractive opportunities, and finding the ones where there's something that's changing or improving. I've just found that a good way over the years of adding value to a portfolio.
I think that's probably the common theme amongst your highest conviction ideas, is something quite specific changing within the businesses. So your stocks don't necessarily screen that cheap on traditional valuation metrics, sort of looking through the rear view mirror, but on a forward-looking basis, you think they are because something is changing, and you really trying. I mean, degree in physics from Cambridge, you like your detail and not afraid of a bit of complexity.
Yeah, but the other thing I think having a sort of scientific background brings is this idea of creating hypotheses and then testing those hypotheses, and that I think is where visiting and meeting companies really helps. You see, look, if this company delivers what I think it's going to deliver, whether it's the growth in dividends from the growth in the Finnish healthcare system, or whether it's additional spend from their customers on decarbonising their steel plants, or another company, Bakkafrost, where I think they can grow a huge amount of volume by basically putting more baby salmon into the sea, smolt, and improving the health and biological conditions in Scotland, which will also have an positive environmental impact. Those are the hypotheses that are going to deliver the returns that we want in the fund, and by meeting the companies that can really help with that. So I think you're right. I've always tried to find something where there's an improvement or a change, and that can be internal. It could be from the business cycle improving for that company. But these are the areas that I think we can help, with the Opportunities Trust.
And you mentioned talked through Daniele a bit before and said it's cyclical. And I think trading off what we think the long-term upside to individual stocks is against sort of macro risks and other opportunities that can invest in is tricky. I mean, there's maybe 8% of Global Opportunities Trust in the sort of European value theme, and it's not 28%. And so how do you think about the trade-off between the cyclicality and the value and in the kind of companies that you like at the moment?
I mean, we have this debate over the desk, don't we? Like, we're pretty nervous, I think, on the US. I think we sort of share that view: debt sustainability, risk of a consumer recession. Obviously, what's happening politically and geopolitically is causing a lot of disruption. So I think we agree on that. And then we sort of have the debate of how does that play into Europe? And we can buy domestic European stocks like Tevestelo. We can buy predominantly domestic stocks like Bakkafrost, and we can buy more sort of global exporters like Daniele. And whether we have a bigger weighting in one or the other, is informed by that view. I mean, I guess the debate point that we have is, can Europe, to a degree, decouple from the US? Now, it will be a challenge, but they have got some reform that they're undertaking, sort of in some ways driven by what Trump's doing with the America First agenda. And they've also got much more fiscal space than the US to stimulate and spend, sort of counter-cyclically. So I guess these are the sort of things we weigh up between ourselves and within the fund, and think about how to position size, particular stocks, and also particular sleeves of stocks within the fund to give that kind of risk reward profile that is appropriate for the macroeconomic environment.
Yeah, I mean, since the financial crisis, really every issue has been dealt with by printing money and trying to stimulate. And I guess, my view and Andy's view, and I think your view as well, actually, is the ability to kick the can down the road is getting constrained. It's possible that the interest on the US national debt could break 20% next year of the total tax take. I mean, that's really the backdrop against which Trump is running around the world trying to save money by charging people $5 million for Willy Wonka tickets. But how we think about the spillover risks of that into Europe is a challenge. But it certainly feels that if where we want, we're much more attracted to taking that risk in Europe than in the US, for example, where we just don't want any consumer exposure at all. Any kind of economic downturn there is kind of obvious, isn't it?
We don't want to be too short-termist, but sometimes at turning points, what companies are saying is quite interesting, and certainly something we've chatted about, isn't it? Is that in Q1, clearly the message from the companies that I'm getting, from some of the stocks we own in the portfolio, but also stocks we don't own, is that what's happened with the so-called Liberation Day has hit the US a lot harder than it's hit the rest of the world. It has slowed the rest of the world, but it's clearly caused quite a sharp, sudden full stop, if you like, a sharp halt in the US economic environment. And so sort of the data is kind of backing up the thesis. I mean, I think we can both create pretty negative scenarios, can't we, for the US, into the for this cycle, and it really comes down to what does inflation do, and does the market continue to want the dollar and continue to fund the US? Once interest rates are 4%, is there a bid for the dollar? And at the moment, there probably is, but that's clearly a downside risk we've got to think about with the portfolio.
I think it's really important, this whole concept of agility as well. And I think, given Sandy and my predisposition in recent years, people could be forgiven for thinking that the Global Opportunity Trust is a sort of bear-oriented strategy, and it's just not the case. Trying to generate attractive real returns over the longer term, but have been trying to do that without taking lots of macro and market risk for the last few years, and trying to trade off these opportunities is the key, isn't it? Where we're not waiting for the end of the world. We just would really like to outperform a falling market significantly, because frankly it's a lot easier to make sensible investment decisions when you're the right side of downturns than when you're the wrong side of them. And the key to compounding over the long term ultimately is to create that asymmetry of return. And so the European sort of value exposure, to me, is a really important component of that, of where we're finding more idiosyncratic ideas that can generate return. And somewhat that's pushing the exposure of the portfolio somewhat counter to the sort of macro, because of the upside that is in the individual stocks. But it's a challenge.
I think timing sometimes is seen as a bit of a dirty word, isn't it, in portfolio management? And obviously sort of punting around, being net long 100% one day and then market neutral the next. That's not what we're talking about. But when the bottom up from a sort of fundamental perspective looks very attractive, clearly that's when you want to be taking more risk. And if that's timing, then that's timing, and it's just not practiced, I think, because returns have for such a long time flowed to different factors because of the very long trending macroeconomic cycle we had in the previous 20 years. Like, people have stuck in one factor, or maybe they've had a barbell of two. And what I think is working, it's refreshing from a investment point of view with the Global Opportunities Trust is the ability to move to where the attractive returns are, and hopefully compound that through the cycle.
Absolutely. All right. Thanks very much.
Yeah, cheers. Thanks, Alan.
Hi, Ross. It's been such a pleasure working with you for the last few months since you joined in January, because we've been talking for a long time, and as a value investor myself, working with someone who is comfortable with faster growing companies and can teach me a thing or two is just so interesting and so valuable, frankly, to diversification in the Global Opportunities Trust over time. So I definitely feel like with this question I should be writing some notes myself, but maybe you could paint a picture for how you think, or where you think the opportunities are going to be for the next 10 years investing in higher growth investment opportunities.
I think it's going to look quite different to how it's looked in the previous 20 years. I think if you look back, the last cycle was all about digitalization. So a number of businesses that were founded in the late 90s, in the kind of concept stage, then kind of came through and scaled, I think, around the 2000s, post 2010. And that kind of topped off, I think, with COVID, with the kind of the last leg of digitalization, a lot of different industries. I think as we look forward, I think AI is going to kind of play quite a big part. The four forces that you've been talking about, we've got a lot of things going in the wrong direction, especially kind of demographics, also working population, and I think there's going to be a need for a lot of healthcare for those, the older population. So I think looking forward, I think two kind of key sectors, technology, where we can try and improve productivity with AI in certain sectors, and then within healthcare, although there's going to be a lot of old people, it's going to be quite hard to kind of fund that healthcare. So we're looking for innovative companies that can kind of make game-changing differences with either products that they supply or reducing the cost of healthcare. So I think that's where we're spending a lot of our time, kind of looking in our focus sectors, which are technology and healthcare, and then kind of broadening out into other sectors. But I think, flexibility, looking broadly across all the markets, there should be opportunities for good returns still, given, engineers' ability to come up with new products and, find opportunities to offset what are challenges in the bigger market.
Over recent years, it seems that everybody's become obsessed with the largest technology companies, the NVIDIAs and things like that. So is that the space where you think the interesting opportunities are going to be for the next 10 years?
Definitely not. No. I mean, personally, it's hard to pinpoint exactly when, but you saw a big build out of infrastructure for the internet. Grew up in Reading, you saw these data centers going up and people were building capacity ready for everyone to be watching streaming television, within 1 or 2 years of Netflix or streaming TV being developed. But it took a number of years for that to come through. I think the same kind of things going on with AI now. You've seen a lot of data centers built to provide the capacity. You are seeing some usage, but I think typically, if you've got 4 or 5 companies all bidding to try and win that market share, they're not all going to be winners. So there's definitely going to be overcapacity built in certain areas. So I think areas like NVIDIA could be kind of looking like they're over trading currently. Then on top of that, if you look at Google today with over 300 billion in revenue, they've got to add, 30 billion revenue to grow 10%. That's the amount of revenue they were doing kind of 10 or 15 years ago. So the ability for the likes of Google or Facebook to continue to find pockets of market share that they can take from other players, either in the digital advertising market, is going to get tougher and tougher. So we're very focused on looking at those companies more in the kind of 2 to 20 billion range. We think there's a number of companies there that developing products or services that can address those problems I was talking about in your previous question, around the aging population, around productivity. So that's where we're going to be looking in the future.
So one of the things I always struggle with is paying too much for anything, whether it's a cup of coffee in London or a stock. And so your kind of space is a bit of a challenge, to be honest. How do you think about the price that's justified by the kind of financial profiles that you predict in your investment world?
I mean, I started my career covering technology for Fidelity back in 2005. So been looking at these sectors for 20 plus years. If you look at the Nasdaq just as a kind of barometer, it's always traded on a premium to the overall market, anywhere between 30 to 50%, but it has got as low as 5 in the mid, around just after the financial crisis. And today it sits at about a 30% premium. So I think you look at it kind of relative to the market is one way you get comfortable with it. I come from a long short background, having done that for 15 years. So I always kind of approach these businesses with, what could be the downside to earnings? What's the risk? Because ultimately, I think in the long run, valuations may go up or down a little bit in these stocks, but it's really the earnings growth that, if that comes through, you get paid in terms of share price appreciation. So focusing on modeling these companies, getting the earnings right on a kind of longer term view, kind of 5 to 10 years out, that's what's really going to matter if you're going to kind of make money in these kind of stocks.
So I'm going to pick you up on that, because you're a growth guy that talks about earnings. Don't growth people just talk about sales because there aren't any earnings? Are you implying that you're actually investing in profitable companies?
Unbelievably, some technology and startup technology companies do make profits. But if you look at our paper portfolio, which we're just kind of building, we've only got one loss-making business, which is due to turn profitable in the next year or two. Technology businesses that are loss-making, that's more kind of for the VC space, and I think they scale up. I think once companies come to market, if you want them to attract an investor base that understands businesses, they have to be in that scale-up mode where profits are increasing, they're doing better than what consensus expects. So we tend to stay away from loss-making businesses.
And so as of today, Global Opportunities Trust doesn't have any of your stocks, so,
Well, for one, I suppose, having joined just around the Trump bump, or the things were looking pretty frothy when I first came here. There was a whole new set of opportunities to, new stocks to look at in different markets. So I've been slowly working my way through all those opportunities. I think it's getting to the point where, given the sell-off and things are looking, more reasonable value, that premium that I was talking about earlier was towards the top end of its range when I first joined. Things are looking a lot more attractive now. So I'm hoping to get a stock in the fund and, cover some of the costs that you're paying me. But yeah, it's going to be fun kind of working together. I do understand, like from a value perspective, I've been looking for those stocks where maybe it fits more in your kind of valuation range, maybe below 20 or below 15 times, which maybe you would feel more comfortable with. But at the same time, we shouldn't miss the opportunities where stocks are trading on 30 times plus. But we've got this kind of great 5-year story for the earnings.
Well, I think the difference, Sandy and I conceptually are completely aligned with you. It's just, in practice, we're going to struggle to feel confident enough in the kind of growth trajectories that you're comfortable with. But that also means that the sorts of stocks and exposures that you have are very diversifying in a portfolio sense. And personally, it's just been really interesting and really positive, if you like, that you weren't pushing on lots of ideas that made sense for the portfolio today, if you like, because part of the framework that the Global Opportunities Trust works within is to try and stick to this sort of limited number of themes, because we think it keeps you honest, if you like. Like, it's just so easy as a portfolio manager to stamp collect, to just end up owning lots of different things because individually they all sound quite attractive, but when you put it all together, it's not a coherent portfolio. So, from my perspective, having no exposure to something but having a lot of firepower and resource and intellectual capital focus on trying to find things in that area is really positive, if you like. And I think, as you say, certainly some of the things you've been talking about recently, I'd be very surprised if the trust isn't buying some of those over the next few months.
And when I look at the themes in the portfolio, even things like defense, that you can have new technologies that came through, and we're meeting a few companies in the coming weeks that fit that theme. Also in Japan, some of the SaaS companies that were trading on high multiples have really come back, and Japan's really a digital laggard. So the digitalization trend that we've seen in companies both in Europe and the US, there's a number of plays just following that same kind of cycle in Japan, which I know is been a theme you're kind of playing within the portfolio. So I think there's definitely ways we can overlap. Just looking forward to working more together, finding those common themes and meeting the companies and getting them in the portfolio.
Well, I quite enjoyed the banter about Jet2 a couple of days ago. Obviously, I was just feeling chirpy because it went up 20% in 2 days. But the point being that from a shorter term perspective, that's a growth company if we're right. Going to compound sales, earnings 15-20% per annum. And then you were kind of countering a bit on the fact that it might pull that off for 2 or 3 years, but you were going for that for 10 years on some of your stocks, which I think that's the difference, isn't it? And that's how you end up with a more diversified exposure and a better quality return profile if you can find those things that can combine, and the sort of thematic way that we think in Global Opportunities Trust and the scenario analysis that we run, trying to think about how different groups of stocks are going to behave in different environments. We need that versatility. We need more raw material, a broader range of ideas in order to enhance that decision making. So it's going to be fun for the next few years.
I think historically I very much looked across the whole market with Graham at Pensato, and Jet2 would have been one of those companies we would have definitely been investing in and we would have worked on together. I suppose over time you find areas of the market, the opportunity matrix we work to. Over my career I've slowly filtered down and down and down the companies I'm comfortable investing in and making money in. And that you look at the portfolio today, it's very focused on technology, healthcare, digital media, and within those kind of sectors, they're always going to be expensive, as I've always said. But the trends in those markets can go on for a long time. So the digitalization trend from the late 90s to COVID. And I think what's really exciting for me is this AI trend that, all the companies we're talking to are putting AI on top of their products, but there's also going to be some kind of AI native companies that kind of come out the wash in the next 2 or 3 years. And hopefully, post the hype and maybe when people get bored of, the actual, theme, there could be some great opportunities to make money on a 5-year view. Maybe not today because they look expensive, but maybe in the future. And it's very much my process to keep meeting the businesses, getting to know them. I don't have to own them day one, but maybe find that attractive entry point where I think, the IRR that you can make on a stock is 15% plus, rather than just owning them, hoping for the best on a 10-year view.
Great. Thanks very much.